definition of a program-related investment. So although the purpose cannot be significantly to make money, that's not to suggest that it can't make money. And indeed they will. They may produce significant income or property appreciation. That just wasn't the driving force in getting this thing going. And again, no political or legislative purpose. So again, we're not going to have any support of candidates and campaigns with money that has as its core tax subsidy. Now, let's talk about the benefits to the foundation which embarks upon a program-related investment into an L3C. The first thing is it's going to avoid legal opinions and private letter rulings. Having said that, and I'll flesh that out as we go on, you've automatically removed the largest barrier to entry. All things being equal, foundations would love to be able to use their capital in a way that can be an asset rather than an expense, a way that can leverage other investments, private sector investments. So the whole necessity of satisfying the foundation that this is indeed a program-related investment is going to go away. It's going to attract outside investors. So this is a way of really having the foundation leverage its social impact and have greater programmatic results as a consequence of its investment. And you will see it has even a multiplier effect, where $1 is going to produce multiple dollars that can be deployed not only for social purposes, but as to private sector players for financial returns. So when we have an asset versus an expense, that asset continues to be available on the balance sheet of the foundation. And let's suppose it's a loan. As the loan is repaid, money is now available for redeployment into the charitable community. If it's stock, money comes back to it as the stock is eventually sold. And again, that money can be recycled. So as distinguished from a grant where once it's gone, here there is a continuing opportunity to use the same dollars over and over again for social good. From the point of view of the L3C, it's getting low-cost money and can receive the commitment of the foundation to make further investments on a continuing basis, contractually, so long as the foundation is willing to do this, and I think many will, so that a portion of their 5% will be dedicated to this L3C for the next 3 years, for the next 5 years. That receivable then can be discounted, collateralized, brought to a bank, and cashed out. So now the L3C has money in its pockets to grow the social purpose business on the strength not of its financial statements, but really on the strength of the foundation's financial statements. So important in the case of a fledgling business with short dollars and no track record. The L3C's promise. Financial self-sufficiency. You will see that the L3C is going to be viable and autonomous. Without the L3C structure, it wouldn't have even existed. It'll also secure the continuing inputs of the foundation. Foundation will generally not just give money, but as any venture capitalist will also contribute expertise, both to protect its own investments and also to really see that the social reach of the L3C is optimized. The L3C, in turn, realizes the benefit of that expertise. As a designee of the foundation, for example, might sit on the L3C's board or might otherwise have involvement or provide infrastructure or establish connections with relationships. The foundation and its board will now have a vested interest in the success of the L3C. Capital flow will come to the double bottom line venture. Double bottom line, delivering both financial returns and social returns, giving unto each that which it seeks. Becomes a win-win for both for-profits that otherwise would not exist and nonprofits who are able to see their dollars go a lot farther than they could only with grants. Write it off and you're done. Let me give you an illustration. And there are really so many different ways to shape these deals depending upon the goals of each of the parties and how to bridge those respective interests in a way that is most responsive to what each party is trying to achieve. So I'm going to show you just a couple of examples. By no means should you consider this as exhaustive or limiting. It's just a way of kind of showing you how these things work in general. So the first is a capital structure where the foundation comes in with the first dollars. That's key because this is a layered investment approach. For those of you with financial backgrounds, we're talking here about tranches, layers of investment, rights in the venture. And the first money in is going to be the foundation. And the foundation is generally going to be in the low profit zone, which is where L3C got its name from, low profit. Low profit zone is where the market doesn't respond. It's not attractive enough. Somewhere between a 0% return and a 5% return. Here I've specified they may receive 1%. Who's going to be investing money for 1%? Well, nobody, unless the alternative to you is just give the money away. And unless you're really after the social returns, which is what this is all about. So the foundation is going to have lower financial returns, maybe no financial returns, maybe zero interest, but a high social return because of the purpose of the business, which we'll get to. And the foundation is going to be bearing the greatest risk. It's the player that comes in first. There's nothing there yet. All there is an embryonic business idea. So the foundation, however, is satisfied its program-related investment obligation. On the strength of the fact that the foundation has put that money in, other kinds of players are now induced to put their money at risk. So here I've specified that a socially conscious investor, maybe an individual, incurs lower financial risk because he or she will have a priority vis-a-vis the foundation should the entity dissolve, and would earn a somewhat higher financial return. Why only a 3% return? Well, maybe this socially conscious investor is content with a 3% return in order to make this happen, this social purpose business. Then we go to the next layer, the next tranche. So now we have the foundation and then the socially conscious investors' money is all put in. And I provided here that market rate money thereby frees up because no longer do we have the risky situation we started with. We have a fairly healthy capitalized investment where others are bearing the risk. So now we may talk about a pension fund coming in, for example, incurring market rate risk and earning market rate financial returns, which I've specified as 6% neatly to get above the 5%. The foundation now comes in after that. And the foundation, being enticed by the fact that the state is in for the first dollars and the highest risk, now says, this is the kind of program-related investment that is appealing to us because we think the viability of the venture is enhanced by the state's participation. So now the foundation earns a low financial return, I'm saying 2%, but a high social return. And then finally, the outside investor comes in, incurs market rate risk, and earns market rate return. Now, this needn't be a socially conscious investor. This is now somebody that thinks, it's a pretty good business idea now that the risk has largely been extracted from it. And again, the rate of return here is 4%, which the L3C can generate, but not without the catalyst of the foundation's program-related investments. But for the foundation, nothing would have happened. So, who's a candidate for this kind of a structure? The L3C must have a socially beneficial mission. Otherwise, it will not satisfy the purpose requirements of program-related investments. And it must have consistent cash flow. It doesn't have to have a high cash flow, but it has to have enough cash flow to entice these players, and they're going to end up with a blended rate on the low end